Making long-term retirement decisions in today's risky market is a challenge. That's why so many smart, logical retirees in Chandler are making the move for their 401k and IRA rollovers to licensed retirement specialist and fiduciary Steve Jur-itch with IQ Wealth Management in Scottsdale. Steve is a Kiplinger contributor and host of the popular daily radio show Mastering Money on Money Radio. Let's listen in on a recent broadcast. At any point throughout, you can visit our website by clicking the little circle with the I in the top right corner.
Now here's leading 401k rollover advisor, Steve Jur-itch.
The biggest challenge for investors as they plan for retirement is not only how to keep growing money, but how to pay themselves and their spouse a guaranteed secure income, like a pension, unaffected by and protected against market declines. That's why so many smart, thinking professionals planning for retirement are rolling over to a self-directed IRA funded by a special form of indexed retirement annuity that may lock in a lifetime income, guaranteed not to go down, up from 5 to 9%, depending on age and deferral period. The annuity may receive a credit for up to 50% of the index with no market losses and have zero annual fees. A very smart move for all or part of a 401k or 403b rollover.
Advisory services by IQ Wealth Management, a registered investment advisor, custodian Fidelity Institutional. Meet with an experienced planner at no charge. Call 480-902-3333. 480-902-3333. 480-902-3333.
Two in the box.
Ready to go.
We be fast and
They be slow.
He's making retirement great again. Kiplinger contributor, best-selling author, and leading financial advisor, Steve Jur-itch with IQ Wealth Management. Right here on Money Radio. Plan, invest, insure, retire, and stay retired. Now back to Steve.
Welcome back to Mastering Money on Money Radio, right after business for breakfast from 8 to 9 a.m. and again at 6 p.m. Monday through Friday. Mastering Money is brought to you daily by best-selling author and wealth manager Steve Jur-itch.
How you doing, everybody?
Steve is founder of IQ Wealth Management in Scottsdale, an independent registered investment advisor and fiduciary with asset custodian Fidelity Institutional. Steve is a local hometown advisor with national resources working with him and is part of an integrated financial network, including Sterling Capital, with more than $52 billion under management and more than 35 CFAs. He is the designer of the Black Diamond Dividend Strategy. Time now for the Mastering Money Q&A session.
Yes, sir.
And today, let's pick up where we left off last time.
All right.
Me with the Q's,
Okay.
Steve with the A's, of course.
Yeah, let's try it that way.
Steve, there's this guy out there who seems to spend a whole lot of money hating annuities.
Oh, boy, he sure does.
In the hopes that he can convince a few more people to do the same. Why do you think he goes so far out of his way to hate annuities?
Let's stop and be logical about it for just a moment. My friend Ken, this guy manages about, I think, $53 billion in assets. And, he gets clients when they're maybe in their 30s and 40s. And then as they hit their 60s and 70s, guess what? They don't want to stay in the market so much. Mm-hmm. And if you stop and think of why he spends literally over $3 million a year on the internet and much more on television hating annuities, it's because he's actually losing business to the annuity industry. We're very aware of him in our industry. At conferences, we talk about him. We used to be so concerned. We're laughing sometimes now. Let him spend the money. There are just so many people that say, look, I'm not letting some grumpy old billionaire who would never need an annuity, doesn't even know what it means to need an annuity, make my decisions for me. The fact is that if you have $2 billion, his net worth is around $2.3 billion. That's not a reason to invest with anybody, by the way, just because they have a lot of money. He could lose $1 billion. He would still be classified as a billionaire. I mean, so that by definition probably don't have a big need for an annuity, especially if you're getting as old as he is. Now, the fact of the matter is he hates them because he's seeing bleeding go out of his bottom line from them. So the fact is that if you look at what an annuity can do for somebody with $500,000 to $5 million in net worth, Somebody with you might say, well, why would somebody with $5 million of net worth or even $10 million of net worth want annuities? Well, what do they want for part of their portfolio? If you've already accumulated $3 million, $5 million, $10 million, what's the first thing you want to make sure you do? Preserve it. You're not out there trying to hit home runs anymore. And then you take a look at the so-called fixed income opportunities offered by a money manager. Guess what they are? There's no guarantees. They'll say, well, the dividend yield is 7% right now. Yeah, that's because the stock price is down. Dividend yield is determined by dividing that dividend payout amount by the share price. So when the share price falls, that company could even be in trouble and could be headed for a problem this time next year. If you buy by dividend yield alone, 6, 7, 8%, you've got no ability to plan. At IQ Wealth, our firm, we make sure that we draw up clear, secure, guaranteed income plans designed to make sure that our clients have a secure surplus of income from now on, no matter what comes their way in the market. The market could fall 60% tomorrow. Our annuity clients, even if they're not taking income yet, they will not have one penny's worth of loss because they've chosen the right annuities. Now, to help Ken out there, if you really look at all his literature, he's mostly talking about variable annuities. So right there, he's a man after my own heart. I agree. I agree. Those fees on variable annuities, 3 and 4%, that's to start out. The problem is the riders grow in value. Let's say that you start out at a $300,000 variable annuity, and it does grow to $400,000, and that income value, the income rider, grows to $400,000. Then you get a 50% decline. The money in your principal drops to $200,000. They're going to charge you the fees on that $400,000. So that's really much more than the 3 or 4% when you really put a calculator to it. And here's the deal: most of my clients own calculators.
Yes,
right. Many of them are engineers and medical people and people who run their own businesses. And they say to themselves, wait, the bonds are only paying 2%. I don't want to risk all my money in the stock market. Money markets over here are paying 0. You mean you have an annuity that'll protect my principal? I can take out 10% per year, penalty free. That's all the liquidity that a person needs if they're putting 20 or 30% or even 40% of their holdings into deferred annuities, not immediate annuities and not variable annuities. The idea is a fixed annuity where your principal can't go down. It's backed by a 100-year-old insurance company that's never lost a penny. This is making a lot of sense for people, and I will guarantee you it's not at all what Ken, our friend, not Ken Morgan, but another guy named Ken, that's what he's really talking about is, and I agree, is that the fees you pay on a variable annuity make it a very, very poor investment.
I get a lot of mail from that other Ken.
Sure. I'm sure you do.
Now, you mentioned variable annuities, and we should all know, because you've told us before, that there are really only 4 categories of annuities. Mm-hmm. And yet you hear so many different terms like new generation, hybrid, and next gen, just to name a few.
Right.
So what's the deal with all these nicknames, and what should consumers know?
Yeah. You go on TV and you see the fellow, and I know Josh, and he's talking about next gen. Well, next gen, next generation, hybrid, they all refer to the identical companies, the identical annuities. There is no such thing as a new generation annuity. You'll find out it relates to a company like a Midland or North American or American Equity or Great American or Nationwide. We represent all those companies. We monitor all of them, and we help people compare out of fiduciary duty. If there was one new generation annuity, it wouldn't be invented by a salesperson. It would be issued by a legal reserve insurance company and who's audited in all 50 states. So what we're really referring to there is a fixed index annuity with an income rider. So a new generation is a hybrid is a new generation, and both of those are next-gen annuities. So the bottom line is, be smart. It's a fixed index annuity. One tip here, by the way, if you're talking to a guy who's sold mostly variable annuities, and I like some of those guys. Met one recently that I hadn't known for years, and we had a ball at an event. Great guy. But the fact is that if they refer to equity index annuity, then they're reading right out of the CFP journal. That's a name that has been outmoded and is actually not even allowed to be used anymore. Yet if they're saying equity index annuity, you know right off this person knows almost nothing about fixed index annuities, because that's what they are.
Now, when it comes to a 401k rollover, Steve, this is a major, major decision for people.
Yeah.
What can an annuity do for a person who's planning retirement versus staying completely in the stock market?
Well, right now, if you just fall asleep at the wheel, the stock market right now, it's going along fine. It might even end up in positive territory by the end of the year. But who knows? I mean, you've got North Korea over there as a problem. You never know about Iran. You've got a lot of issues, pulling out of the Paris, the environmental accord. What do we call it about that? Climate change. A lot of things could happen. A lot of things. What really has been pushing the stock market upward is the belief that Donald Trump will get his tax relief bill passed, maybe the health care bill passed. That's what the trade is. Instead, people are now realizing he may not get any of it passed. If not, you're going to see interest rates start falling again, and you're going to see the market perhaps just kind of flatten out. And retired investors can't afford to fall asleep at the wheel. Then you could have some event come along, and you could have a 30 or 40% decline. So we really want people to realize if you have a 401k rollover, this is a decision like buying your house. Major, major, major. You can buy a fixed index annuity, and some models now come with zero annual fee deductions, no money out for commissions, no money out for management, no fees at all, and you can even have an income rider. And guess what? That income rider can come with a long-term care benefit, and the income you can choose to have it increase for inflation. So if you have a legacy motive, you want to make sure that you're not buying an immediate or a variable annuity. You're buying a fixed index annuity that will protect your principal. You can even get a bonus of anywhere from 5 to 10%. There are just features you can get on an insured basis to protect your principal with 20 to 40% of your entire net worth, maybe more. We've got clients with 60% of their net worth in several deferred annuities, and they can get plenty of liquidity when they want it. The main thing is, let's take a look at a $300,000 annuity deferring for 7 years for a 60-year-old. Well, they can end up with a $26,000 a year income for life.
To learn more about making the move for your 401k and IRA rollovers, or to hear the rest of the show, click the link to visit the IQ Wealth Management website. Click the link now if you want to retire and stay retired with the right strategy for you. Take a few seconds and click on the website link now.